PAXG just broke parity with spot gold, not by cents, by double digits. Mexico is quietly pulling gold home and tightening its grip on silver exports. And COMEX open interest just compressed into a pattern we have only seen 3 times in the last decade. Every single time, silver gapped higher. OG Anna AG here. You clicked because something in the markets does not add up. Good. That instinct is worth more than any headline. What I am about to show you connects 3 dots that Wall Street hopes you never line up. Quick question. When was the last time you checked what people actually pay for gold on a blockchain versus what London says gold is worth? Most investors never check. They assume the price is the price. It is not. That gap, that spread, is a trust indicator. And right now, it is screaming. If you are here to think, stay. If not, there are plenty of green candle compilations elsewhere on YouTube. Let us get into it. So what is PAXG, and why should you care? Pax Gold. 1 token equals 1 troy ounce of real gold, held in Brinks vaults, regulated by New York, audited monthly. This is not a meme coin. This is institutionally custodied metal on a blockchain rail. Here is what just happened. PAXG started trading at a persistent premium to spot gold, not noise. $12 to $18 above spot on regular trading days, spikes above 25. Now pause on that. Why would anyone pay more than spot price for the same ounce of gold? One reason. They do not trust the traditional system to deliver. Futures can be rolled, settled in cash, rehypothecated. PAXG cannot. You buy it, you own a specific serialized bar. Period. When did we last see this premium? March 2023. Silicon Valley Bank collapse. Before that, March 2020. COVID liquidity crisis. Both times gold rallied hard afterward. Both times silver followed, with a lag, then exploded even harder. But here's the part nobody is covering. On-chain data shows PAXG transaction volume up 41% month over month. Wallets holding more than 10 tokens, that is roughly $24,000, up 9%. This is not retail buying fractional gold. This is serious capital moving outside the banking settlement system, and they are paying a premium to do it. Ask yourself, what do they know? Now let us connect the second alarm. Mexico. This is where it gets dangerous for silver shorts. Banco de Mexico holds roughly 120 tons of gold, most of it historically stored at the Bank of England in London. Standard practice for central banks. You trust London, you leave your gold there. Except Mexico just quietly reclassified a portion of those reserves for the 3rd consecutive quarter. The reporting structure changed in a way that data suggests physical metal may have been moved or reassigned from London custodial accounts to accounts under different jurisdictional control. Sound familiar? Poland did this, brought home over 100 tons from England in 2019. Germany did it between 2013 and 2017, 674 tons pulled from New York and Paris. When central banks start bringing gold home, they are not doing it for decoration. They are preparing for a world where trust between institutions breaks down. But here is where it gets really interesting for silver specifically. Mexico is the largest silver-producing nation on Earth, 6,300 metric tons in 2023. Nearly 1 in every 4 ounces mined globally comes from Mexican soil. And right now, Mexico's Senate is considering legislative proposals that would tighten controls on raw silver ore exports, favoring domestic refining, keeping more metal inside the country. This is resource nationalism, and it is accelerating. Now check this data point. Silver exports from Mexico to the United States declined 8% year over year in the most recent period, but mine production stayed flat. That gap between what Mexico produces and what it ships, it is widening. Somebody is absorbing that metal domestically, and the global market has not priced it in. Add the geopolitical layer. U.S.-Mexico relations are strained across trade, immigration, energy, and security. The USMCA trade review hits in 2026. Tariff rhetoric is escalating. A Mexican central bank repositioning gold. A Mexican legislature tightening silver exports. A deteriorating bilateral relationship with the country's largest trading partner. These are not disconnected headlines. They are one story. Now let us look at where the actual price gets set. COMEX. The latest commitment of traders' data is remarkable. Commercial short positioning in silver futures, the lowest level in 14 months. Commercials are the banks, the refiners, the producers. These are entities with direct knowledge of physical supply conditions. When they reduce shorts, it means one of two things. They expect higher prices, or they cannot source enough physical metal to maintain those positions confidently. Either way, bullish. Meanwhile, managed money, hedge funds, trend followers, net long but modest, not crowded, not euphoric, just positioned. The ratio between commercial shorts and managed money longs is compressing, and this compression pattern has a track record. Spring 2020, before silver doubled. Summer 2016, before a 30% rally. Early 2011, before silver ran to nearly $50. Every time this coil tightened, it released to the upside. Now here is the mechanical part most people miss. Options expiry. There is a significant cluster of call open interest at the $28 and $30 strikes approaching the next major expiry. Market makers who sold those calls must delta hedge by buying futures as price approaches those levels. This creates a reflexive loop. Price rises, hedging increases, price rises further, more hedging. It feeds on itself. But, and this is critical, paper mechanics alone do not sustain a gap move. You need a physical catalyst underneath, a supply disruption, a sovereign purchase, a shift in industrial demand. And what have we just spent the last 10 minutes discussing? Mexico tightening the supply valve. PAXG signaling institutional distrust of traditional delivery. The physical market is providing exactly the kind of catalyst that the paper structure needs to ignite. Zoom out further. The global pricing architecture for precious metals is fracturing. The Shanghai Gold Exchange has been running a persistent premium over London for nearly 2 years, at times exceeding $40 per ounce. This is not normal. For decades, arbitrage kept London, New York, and Shanghai in tight alignment. That alignment is gone. China continues importing gold at elevated levels through Hong Kong and direct channels. The People's Bank of China added to reserves for 18 consecutive months before going quiet. But trade flow data suggests accumulation continues through state-adjacent entities. Now look at silver. India imported over 10,000 metric tons of silver in 2024, record levels. To put that in perspective, total global mine production is roughly 26,000 tons. India alone absorbed nearly 40% equivalent. Where is that metal coming from? Redirected trade flows. Silver that previously supplied European industrial consumers now flows east because Eastern buyers pay premiums that Western paper markets do not reflect. This is the divergence that should keep you up at night. The paper price of silver, set by COMEX and London OTC, is not reflecting physical reality. And when paper and physical diverge too long, the reconciliation is never gradual. Look at nickel in March 2022. Price doubled overnight. Trading halted. Chaos. Look at uranium over the past 18 months. Paper said one thing. Physical said another. Physical won. Silver's divergence is widening right now. The question is not if reconciliation comes. The question is when. Let me show you the pattern because it is getting hard to ignore. Silver ran from $5 to $50. Catalysts: inflation, geopolitical instability, loss of monetary confidence. Everyone blames the Hunt brothers. But the Hunts did not create the conditions. They exploited conditions that already existed. 2010 to 2011. Silver ran from 18 to nearly 50. Quantitative easing, zero rates, European sovereign debt crisis, physical demand surge. Both times, the move was preceded by prolonged consolidation that exhausted sellers. Both times, COMEX inventories declined before the breakout. Both times, signals appeared in adjacent markets weeks to months before silver moved. Gold premiums, mining stock divergences, central bank behavior shifts. Sound familiar? Today, COMEX registered silver, down from over 150 million ounces in 2021 to roughly 35 to 40 million. Paper claims to registered ounces, elevated. And demand has fundamentally transformed. Silver is no longer just money or jewelry. It is an industrial necessity. Solar photovoltaics. Each gigawatt of solar capacity requires roughly 20 to 30 tons of silver. Global solar installations are accelerating. Electric vehicles, fifth-generation telecommunications, military applications, medical technology. The Silver Institute projects industrial demand exceeding 700 million ounces annually within 2 years. Mine supply is not keeping pace. Recycling is not filling the gap. The structural deficit is not a theory, it is arithmetic. Now, intellectual honesty requires this section. The bearish case is not trivial. If the Federal Reserve holds rates higher for longer, real yields stay elevated. Money parks in Treasury bills at 5% instead of non-yielding metal. Opportunity cost matters. A genuine recession, not a soft landing but real demand destruction, would hit industrial silver consumption. Solar subsidies could be cut. EV adoption could slow in a credit-tightening environment. The PAXG premium could be a technical anomaly. Crypto market liquidity fragmentation rather than a real gold demand signal. Mexico's reserve reclassifications could be administrative, bureaucratic, not strategic. Any single signal can be noise. I acknowledge that fully. The question is whether 5 signals from 5 different markets pointing the same direction still qualifies as noise. That is a judgment call you have to make yourself. Rapid recap. 5 signals. 1. PAXG premium expanding. Sophisticated capital seeking gold outside traditional systems. Matches stress patterns from prior crises. 2. Mexico repositioning gold reserves and potentially tightening silver export controls. The world's largest silver producer going sovereign. 3. COMEX commercial shorts at 14-month lows. Option structure creating reflexive upside potential if a physical catalyst arrives. 4. East-west pricing divergence widening. Paper and physical markets decoupling in ways that historically resolve with violent repricing. 5. Historical pattern match. Inventory depletion, industrial demand acceleration, and monetary uncertainty, structural parallels to 1979 and 2011 pre-breakout conditions. No single signal is conclusive. The convergence is what demands attention. I want your analysis, not a guess, an analysis. Based on what we just covered, PAXG, Mexico, COMEX positioning, east-west divergence, historical pattern, where does silver trade in 90 days? And which signal do you weight heaviest? Drop it in the comments. The smartest thinking on this channel comes from this community. Prove it. If this is the kind of work that helps you see markets clearly, subscribe. But only if you take this seriously. The next update on these signals may be the most important one I have put out this year. Hit the notification so you do not miss it. The signals are there for anyone willing to read them. The only question is whether you see them before the move or after. Analyze the data. Think independently. OG Anna AG, out.